Hello and welcome to a new episode of Majlis and Markets. I am your host Hassan Jivraj. In this podcast, we bring you thought-provoking conversations with influential leaders in Islamic and global markets. As usual, before we begin today, wherever you're listening to us, please remember to like, share and subscribe. It really does help us out. You can also send your feedback, comments, questions and suggestions to our email hassan@majlisandmarkets.com. In today's episode, we're talking about Gulf institutional finance. In recent years, private capital and institutional finance in the Gulf have surged, with investors venturing into infrastructure and emerging sectors like private credit and equity. This has attracted attention from major players like BlackRock, especially focusing on key Gulf markets like Saudi Arabia. To understand this evolving landscape, we spoke with Richard Banks, a seasoned expert in financial communication and investment. With over 25 years of experience, Richard has played a crucial role in shaping the region's financial narrative. Today, he guides private clients through Soling Partners, a boutique advisory firm. During our conversation, we delved into the diverse investor pool and the traditional and emerging asset classes shaping the Gulf's financial trajectory. Richard Banks, welcome to Majlis and Markets. Good to have you here.
It's really nice to be here, Hassan. Great to see you.
Richard, you and I go back quite a long way. I know I think I got to know you in 2013 when I started off at Euromoney or Global Capital, writing about Islamic finance. And you obviously were very influential in the conference space for Euromoney. But today, obviously, you're involved in fundraising and institutions in the Gulf. But before we get into all of that, could you give our listeners your story or how you got into the Middle East?
Sure. So I joined Euromoney in '95 as the worst of all possible things, which is as an advertising salesman with an emerging markets brief. And in those days, we were very fortunate that we could pretty much decide where we wanted to go. And so it was decided for me by my boss that I should go to Israel because that was the place I could do the least damage in terms of relationships and not selling. And I duly did no damage at all and sold nothing. But they decided to keep me. And very soon after that, so it was probably about March '95, I was dispatched to Bahrain to research and prepare for a book on Islamic finance, and also to raise money for it through sponsorship. And I'm pleased to say that after about a year, we managed to produce that book, and that was my first introduction to the Gulf. And I remember it to this day, being welcomed in a majlis by none other than Mohammed al-Shrugi, who was then head of Citi and is now, I believe, still very much involved with Investcorp. Incredibly hospitable to someone who really didn't have a clue about what was going on. I then worked a general EM brief for Euromoney until around 2004, 2005. So I was very fortunate to go really literally all over the world: Africa, Russia, Central Asia, Caribbean, Latin America. There's pretty much no part of the world that I didn't have the opportunity to visit. And it was very much the sort of heyday of globalization. So an amazing experience, great people to work with, a lot of freedom to do both editorial and commercial work. And then I was asked by the then CEO of Euromoney, a guy called Richard Ensor, to take over the running of their very successful Cairo conference, which brought me back to the Middle East. That was about 2003. So we relaunched that. And then very soon after that, we, under the auspices of the then chairman of Euromoney, Porrick Fallon, who was a great friend and mentor to me and many others at Euromoney, we launched the Euromoney Saudi conference, which was the first foreign finance, capital markets and investment conference that ever took place in the kingdom. And we had to have special dispensation to get visas. But really that brought me to the Middle East properly. I then spent the better part of a decade, just over a decade actually, about 11 years running and their EMEA emerging markets events business, which covered Africa and a few other places, but it was mainly focused in the Middle East. And we did the inaugural event for DIFX. We did a finance week for DIFC, both when they were very much sort of holes in the ground. In the early 2000s, obviously Saudi, we did one or two events there a year. Bahrain, Kuwait, Qatar, very successful. Egypt kept on going. I was in Egypt working with the conferences team during, not after, but during the revolution. So I saw that firsthand the first week from the Semiramis in Tahrir Square. And then but we built a fabulous business. It was enormous fun. I mean, there were some pretty scary moments on occasions, but great fun. Really exciting to get to understand the region, get to understand and know the senior people in the finance sector, from ministers, policymakers, regulators, bankers, and see how the region was developing its financial sector over the course of the 12 or 13 years that I was very closely involved in it. I then decided that I had had enough doing it. I'd spent enough of my professional career worrying about microphones and delegate numbers and ministers not appearing on time. So I left at the very end of 2016 and in very end of 2015, early 2016, with my partner, Marius, who is Marius Vagantis, business partner, not marital partner, set up Soling Partners, which is a boutique advisory firm designed to advise asset managers on their strategic engagement with the Middle East. We're not a placement agent. We're not a specific fundraiser as such. What we do as a firm is to sit with our global clients and to some extent with the investors in the Gulf and advise them on the best way that they can engage productively with the region. That's a lot of what we're going to talk about today, which is our sort of philosophy and approach. But we saw an opportunity in the market because there was then, and there still is, amongst particularly asset managers, but others, a real lack of understanding on how the Middle East actually works, what types of strategies and products are suitable there, how you should engage with the various different institutions and investors in the region. And it's a far more complicated and nuanced market than many people think. And that lack of understanding as to how the place works, what you need to bring to the table, who you need to be talking to, often results in managers failing to reach their potential or in some cases failing to reach any form of potential at all. So my daily bread is talking to global managers about what they're doing in the Gulf and designing strategies and products and ideas that they can take to investors.
Yeah, I was just going to say, I remember when at Euromoney conference in Bahrain, I think you were interviewing, the finance minister at the time, back in 2013, and
I think it was the central bank governor.
Central bank governor, yeah, the one who just left. I think like your career when you were at Euromoney doing the conferences really solidified your understanding of relationships and how important relationships are. Would you say like obviously you were doing that before like 2017 when this whole opening up in places like Saudi Arabia or the UAE? Would you say that that 10, 12-year experience like prepared you for interacting with C-suite level asset managers?
Yeah, I mean, look, you got to, in the investment management world, you got to take performance and good quality performance, high performance as a given. I mean, if you're bringing some rubbish product or a rubbish underperforming strategy to the market, it doesn't matter how many relationships you have, it's still not going to fly. So, but good performance is not enough. You need to understand your client. I personally don't think it's specific to the Middle East. I think that you look at the top performing global managers in terms of AUM growth, people like BlackRock and Blackstone and Apollo and all of those guys. Why do they do well? It's because they've got a real client focus, and they really listen to what their global clients want, Middle East ones included, and they adapt and amend what they're delivering to what those clients want. And it's not rocket science to then say, well, that's why they are so successful in gathering assets. So, yeah, our relationship's important. Yeah, but what is a relationship? It's a deep understanding of your client's needs and an ability to and willingness to deliver on those needs and to build trust. Now, I don't know about you. In fact, well, no, that's not true. I do know about you, and I know that you agree with me on that. Is that an overly transactional, here today, gone tomorrow, I win, you lose way of doing business, I think sucks. Whether you're in, Guatemala, Godalming, or I can't think of anywhere in the Middle East begins with G.
Panama, or like, oh yeah,
Panama.
yeah.
It's humanity. You want to if you want to deal with someone that you feel is a solid partner and can be trusted. You don't want to be exploitative either way. You've got to be looking to develop outcomes that are mutually beneficial, and none more so in investment management. Your job as an investment manager is to produce exceptional returns for your clients, and you should be in line. You should get exceptional returns for yourself if you can do that. Sadly, a large part of the investment management industry is simply profiting on the management fee and underperforming for their clients. And the Middle East doesn't like that in the same way that other parts don't like it. So, yeah, the Middle East does have its own character. It has its own processes. It has its own idiosyncrasies. But at the core, what we're about is doing good business.
Very good. Richard, we had a Diego Lopez on a few episodes ago talking about sovereign wealth funds and specifically sovereign wealth funds in the Gulf. And it was a good breakdown of the kind of sovereign wealth funds and what they're doing in each country. But with your enterprise and your new, your relatively new gig, what kind of funds or in terms of capital raising, what kind of funds do you work with?
So we work right across the whole spectrum. So we work with the sovereign. Well, our clients work with the sovereigns. We work with the sovereigns. As I said, my partner Marius is ex-Mubadala, so he knows a lot of the people there. He was a very early employee. I know a lot of people at various different sovereign wealth funds. So yeah, sure, we work with them. We work with the pensions. We work with the local asset managers, financial institutions, family offices. We work right across the spectrum. Generally, we prefer, all of our clients, so the international clients that we have, are institutional asset managers. Yeah, they may have retail arms, but we're looking at the institutional space. So the criteria that we use when we are advising our clients as to whom they should be speaking is that do you have a genuinely institutional counterparty? Are these people regulated, professional? Do they have processes? Is the governance good? That's what we want to see in a potential counterparty in a strategic partnership with one of our clients. So we're not working with retail. We're not doing a lot of work on what I would call the sort of smaller single family offices. We absolutely aren't talking directly to high net worth individuals or anything like that. That's not our game. It's about how do you build an institutional business in the Gulf, either on the ground or via partners, which we advocate very strongly as a good way of doing it, or in some cases, remotely.
Great. Before we get into the kind of asset classes they invest in, the Gulf to me, I remember studying about it back in 2008 at university, and the likes of Qatar Sovereign Wealth Fund saving Barclays, or you're hearing about other Gulf entities getting involved in Western infrastructure. Why do you think the Gulf is a unique place? I think, on other panels and podcasts and platforms, you've spoken about the Gulf. What makes the Gulf unique in terms of fundraising?
Yeah, that is what this. I think this is what this podcast is about, because it's not an easy question to answer in a few sentences. I think, you have to look at the history of it. I mean, and I don't want to go over the same ground that Diego, who I don't know well, but I have met a couple of times, and I hugely respect the work that he's done, with his team, and he's a really, really good person to have had on, and I listened to it. I thought it was an excellent piece, really, really clear, really insightful. So I don't want to sort of do too much over the top of him, but the Gulf is the thing is, I think that if you look at the history, the Gulf was much more homogenous. You had the hydrocarbon surpluses that were directed into what were essentially future generation funds, to ADIA, KIA, to some extent, to a lesser extent, SAMA, QIA, where the surplus budget surpluses couldn't realistically be absorbed in the local economy due to the size of the local economy, or in the case of Saudi, the nature of the local economy. Therefore, you diversified and you invested internationally, and you used investment managers because you didn't have the capability or expertise of doing that yourselves. I mean, that's the model, but that isn't. I mean, that's not how it is. It's not how it is now. I mean, all of the sovereign funds are different both in character and in objective. They're all extremely dynamic. Well, maybe some of the Kuwaiti ones could be a little more dynamic, but they change. They change in terms of their objectives, in terms of their structures, in terms of their teams, in terms of their strategies, based on where they best perceive value in today's market. 3 or 4 years ago, everyone was throwing the house at venture. Some of that went very well. Some of it didn't, as I think you discussed with Diego. I think some of it went well, then went badly, and will go well again. Now everyone's looking at credit for obvious reasons, and we can talk about that. But they're also investing in private equity. They're also still investing in venture. The split between a PIF, which is, let's say, 85% concerned with the development of the Saudi economy in terms of its AUM, and I would say, the PIF's investable AUM is probably more like 90% deployed locally, because it's the engine for Vision 2030. Or ADIA, which is entirely concerned with future generations of Abu Dhabi citizens, and therefore is 98% deployed internationally. They're completely different organizations on almost every respect. And then you've got someone in the middle like Mubadala. Mubadala is an amazing organization which is migrating really from a model of being a strategic development fund charged with the development of industries and the economy of Abu Dhabi, to being effectively a global private asset manager with its own private equity teams, venture teams, infra teams, private credit teams, and as you pointed out, you've got MCS, Hani Barhush's team, Badla Capital Solutions, which is, absolutely set, and I think will succeed on becoming a third-party asset manager. Not to say all their stakes in other asset managers. So, I mean, I think of Mubadala as more like a Blackstone or an Apollo than a sovereign wealth fund. And, I hope they don't object to me saying that, but that's the way they roll. And that is really different to KIA and QIA. And so this idea that all Gulf is like, all sovereign wealth funds are like this is not true. I mean, arguably it's never been true, but it's really not true now. And it's one of the mistakes that people make when they're trying to look at their capital raising strategies in the Gulf, is just assuming that A, the sovereign funds are the only game in town, which they're not. B, that they're going to invest in anything, which they won't. C, that they don't have their own strategies, and whatever piece of garbage a fund manager turns up with is the thing that they absolutely need to do. You don't take an allocation request to the large sovereigns. You take a deal. You take some form of idea, some form of innovation, some form of capacity that your firm has that only you can do, or that you're very good at, and you've got to bring some capital with it, put some skin in the game, either on the ground in terms of setting up an office or building a team or doing some knowledge transfer, or you structure the deal as a co-invest. The days of turning up with, here's my US equities fund. Would you like to invest in it? I mean, they'd just laugh you out the room if you got in the room, which you probably wouldn't. And that's just the sovereigns, and there are only really sort of 12 of those. But you step outside, you look at the pensions are different. The financial institutions are different. Some can invest off their prop book, some can't. It's an incredibly nuanced market. And it's also very, in areas, there's a lot of capital constraint. And we just wrote a piece for our clients about Saudi. Saudi, I mean, if you buy into the numbers that are given by the PIF in terms of the capital requirements for Vision 2030, and personally, I think they might be a little optimistic. I think they're going to need more, and I think they know that. You add up all the assets and you add up the needs for capital, and Saudi needs capital. It needs to invest globally, but it's doing that because it wants flow back. It wants co-investment. It wants international people to invest in the kingdom. And, that country can absorb trillions of capital over the next 15 years. Not all of it, I think, will be wisely allocated, but I think that's just a necessary part of the amazing development that's happening in the kingdom. And I think people are overly critical of that. But my point is that, what's happening in Saudi is a fundamentally different thing to what's happening in Abu Dhabi. And what's not happening in Kuwait, for example, is a fundamentally different thing from what's happening in Doha. And that if you come to the region with a pitch book and a one-size-fits-all strategy, you are going to smack up against an enormous, let me change my metaphor. You're going to fail because you aren't thinking about your customers. You aren't thinking about your clients. You're thinking about yourself. And that's where so many people fall down.
Yeah, no, I was just reading yesterday an article about Mubadala doing a massive deal in Brazil, involved in biofuels, and I guess like Brazil's becoming a major trade partner with the UAE in Latin America. So obviously it's no coincidence that Mubadala is doing like these kind of activities in places like Brazil. That's not just like one example. There's like many examples of them going into markets where you wouldn't think that a UAE entity would be involved in.
Yeah, so MCS, so the Mubadala, sorry, not MCS, Mubadala Capital team is responsible for what they call the SIPs, the Sovereign Investment Partnerships, which the UK has one, and there are a whole variety of others where the UAE's strategic investments in nations are coordinated through the teams at Mubadala Capital, and they the Brazil deal, there was the Mubadala did or announced last week. There was another one to invest in a urea deal in Australia alongside GIP, I think. I didn't know urea was infrastructure, but there you go, probably is. These are large co-invests, which could, but don't necessarily have to have a strategic meaning for the UAE. But I know, we know Mubadala well, and I know that strategic or otherwise, they are going to be doing deals where their return expectations are pretty solid. They're not handing out cash, that's for sure, strategy or otherwise. And it's a very important part of the diplomacy of the Emirates. I mean, you got to remember that these countries, with the exception of Saudi, and even Saudi itself isn't that big. I mean, these are small places. Populations, a couple of million. case of Qatar, 350,000. There's an element of of wanting to have friends globally, wanting to have people where you have those relationships, so that in the event of difficulty, and the Middle East is still, sadly, as we've seen recently, a troubled region. You've got people around the world whose doors are open to you and can hear your voice, and they use their capital as part of that diplomatic effort. But as I say, they're not stupid. They're not giving the money away. They are making sensible investments with a view to a return, but they'll allocate it diplomatically or allocate it geographically with an eye to the strategic relationship between the nations. And I could do nothing but say, well, why wouldn't you do that? That's a very, if you have capital to invest, why not use it properly? And I think they are.
Yeah, absolutely. Richard, with regards to the funds and the asset classes, could you walk us through like what kind of asset classes these kind of funds or kind of fundraising is involved in?
Yeah, I mean, so the zeitgeist is clearly in in alternatives, in private markets. People tend to forget that there is actually quite a lot of money invested across the region, not just from the sovereigns, but all of the pension funds have public markets portfolios. Most of them increasingly are run in passively, although I was on a call with a client this morning to say that one of them has decided now to selectively go back into active management in the public markets, particularly in credit. So, there are there's a lot of fixed income, pure old fashioned bonds, loans held on the balance sheets of all of the funds, plus the central bank. We haven't thought about the central banks, but there's pretty much, I don't know, just quick top of my head, $750 to $1 trillion of assets on the central bank balance sheets in the region. Now, most of those are going to be in liquid fixed income. Why? Because the central banks, in addition to being the monetary policy levers of the government and the regulators of the financial sector, financial institutions, banks particularly, are also charged with managing the currency pegs. So the region's currencies are all pegged to the dollar, with the exception of Kuwait, which is pegged to a basket of currencies. So if you look at Saudi, SAMA's had a consistent 450 billion international assets pool since 2017, when the excess was transferred out to PIF. So that SAMA used to be, or Saudi Central Bank as it's now called, was the sovereign wealth fund for Saudi Arabia. So they had a small book of equities, alternatives, all that type of stuff, which I can't remember what there was a special name for it, but I've forgotten what it was. But the vast majority of their holdings are treasuries and other sorts of
US treasuries, right? US treasuries, they held a lot of those.
Yeah, because if you've got to manage your currency hedge against, your currency is pegged to the dollar. You've got to have that firepower to be able to defend that peg. And despite everybody, one of the sort of running jokes we used to have at the Euromoney Saudi conferences that we'd ask them every year, when were they going to open their stock market to foreign investment, and when were they going to let the currency float? Well, the answer to the second is never, if they could possibly avoid it. Despite their swap lines with the China, with renminbi swap lines that they brought in and all of that, the global economy is a dollar economy. Oil is priced in dollars. De-dollarization is happening, but it's happening very slowly. You've got to defend your currency. So what do? You keep a fixed income portfolio at your central bank. So there's not, and then every bank in the region's got a fixed income portfolio. So there's a huge amount of held fixed income, both conventional and Islamic. I don't need to tell you, Hassan, about Sukuks, far more about that than I ever will. But and then there are public equities. The PIF has got, and PIF can call me up and shout at me if I got this wrong. But but I think it's around 20 billion of US direct equity positions.
Sounds about right. Yeah.
Some of those are, sort of strategic. They own a lot of shares in some of the software companies. These aren't the sort of private market stuff. This is tradable
Public
public.
markets. Yeah.
So there's a lot of that. There's less and less of the, long only US value funds because people can get that passively now. There's still some, but it's not a growth area. So, we mainly work, although we have clients, or one of our clients has, what did you tell me this morning? 380 billion of essentially liquid, actively managed funds. And they get traction in the Gulf. They're very well known, very good, very well respected people. So there is buy for that. It's not huge. It's not growing. But if you're a small niche emerging market equities fund, I don't think the Gulf is going to provide you with a great deal of capital. It's not sexy. It's not interesting. The fees, why would someone pay 100 basis points management fee for you to do something that a passive fund could replicate at 25 bips?
You say that, but what about this deal that was done recently with MBK Wealth? I think that just happened last week. I don't know
I think that's private markets, isn't it?
I think it was alternative. Yeah, I think alternative markets.
I think it's alts. I think it was. I saw the deal. I don't know the details of it. I think it's to do with sort of bringing private credit and private equity to the region. So it's not a distribution play. It's more of we've got a team that can originate. We could talk about that in a minute.
Sure.
But so the current flavor of the month, as it is everywhere, is private credit, and that is running the gamut, from senior or direct lending, senior secured, right the way down through the stack to CLO equity. There is bid for all of that across the region. Increasingly, investors want to see, want to see something a little special. I mean, a lot of them are heavily deployed already into the senior tranches of private credit, or they have extremely well established relationships with global managers. Again, going back to Mubadala, who, Mubadala have capital partnerships with, I think, 9 global managers across 19 different strategies. Goldman's, they're doing Asia private credit with Goldman's. They have a sleeve with Barings. They've got real estate with a couple of people in Ares, I think, Ardian in infra. These are co-investment sleeves. Blue Owl, we're in venture. So these are to co-invest. So Mubadala will commit alongside these managers. If there's $100 million deal, Mubadala might take 50 million of it or whatever. And they're very keen. The guys in the Mubadala credit team are extremely keen to build their books. But, if you turn up with a plain vanilla subscale US direct lending fund, why would they give you any money? They see every deal in the world. They can do it themselves. I mean, they can literally, with their own private credit team, could put 50, 100, 200 into a deal if they want to. And especially as they've got these partners who will bring them a deal on which the due diligence has already been done to say, hey, we're going to put money in. Do you want to come in alongside us? And, so if you're going to go to those guys, you've got to come with something that is really interesting and different and unique. Whereas if you're going to maybe one of the smaller development funds or endowments or whatever, the issue may be, well, look, we love Sharia, we love private credit. We love if we can get, low single digits, maybe even mid-teens, low double digits, mid-teens. That's a great return for us. Yeah, wonderful. Oh, hold on a second, it's not Sharia compliant. We were talking with a large endowment last week in Saudi who would really love to do it, but they can't. It's not. There's no way you can turn private credit into a Sharia product if you're really serious about Sharia. Now, most people have found a way around that and are happy to use various feeders and structures, and that's great. But you don't know. I mean, we know because this is what we do every day, but we will know which ones are sensitive to it, which scholars will agree to which structure and which type, how the accounting has to work and all of those types of things. So what may look like a uniform set of investors have in fact very different requirements when you really know how they're deploying. And so credit is very much in fashion. You got to remember that the way the Gulf thinks is exactly like the rest of the world. You take your base rate and you work out what your spread needs to be over that in order for it to be an attractive investment. Now, GCC sovereign, so risk-free rates, are on average between 75 to 150 more for the smaller ones, for Bahrain and people like Bahrain and Oman over US over SOFR. So 3-month SOFR is 5.5, 5.25, whatever it is. You've got to be, to get people interested in the region. You've really got to be delivering. You've got to start at about 7.5, 8%. So if you bring a deal, an opportunity that is delivering 6, it's not. I mean, forget it. It's not going to work. You need to have high. You need your basic base rate for anyone to pay attention to you is probably around 8, 8.5 in the credit space and upwards, ideally more. And that's 3 or 4 years ago you couldn't get. You had to take some pretty wacky risk to get to 8%, and 8% is the minimum, and it was the minimum really for anything risky in the Gulf before rates went up. It's weirdly stayed more or less the same. And so a deal that you could place in Europe at 4, 4.5, or Japan or wherever wasn't going to get anywhere in the Gulf. Now you can, good quality private credit can still do you 10, 11. If you take a little bit more risk, you can get it into the mid-teens. If you take a lot of risk, you can get it into the 20s. Last year, if you were a good CLO equity manager, you were doing 20 plus. So it's not, but you're taking a risk. So that's why credit has become much more of a thing in the region now, today, than it was before rates started going up. And it's the same everywhere in the world, but it's relatively new in parts of the Gulf. And we've seen a lot of the aggregators and a lot of the financial institutions investing into private credit in the last 18 months for the first time. So they're on a learning curve. I think some will be very pleased with the outcome. I think others may not be, because I'm not entirely sure that they haven't really invested through the cycle. So credit is very hot. Real estate credit, similarly, selectively, not commercial. Personally, I think there probably are going to be some really interesting opportunities in commercial real estate credit, precisely because it's a market that's being a bit shunned. 3 years ago, you couldn't touch retail. Now retail is back. So there are cycles for these things. So real estate, generally, equity and credit, always a very strong asset class in the Middle East. It's an asset class that people understand, as you know. And it's one they feel a great affinity to. So they like the idea of owning a physical asset, even if it's only a partial ownership of said physical asset. But we're still like a lot of investors globally digesting the low interest rate environment where yields on real estate were pretty compressed, and that switched post-COVID, and I think people are still sitting on assets that really aren't worth what they are willing to accept. and sort of extend and amending on the credit and various different things. So yes, real estate still very much of a favored asset class in the region. Perhaps a little less so than it was pre-COVID, pre-rates rises. But there's always going to be a market for that, and not, it's not just buying a trophy asset in the center of Munich or Hong Kong or wherever. It's buying now literally anything: multifamily, industrial, logistics. Data centers are extremely hot at the moment. We've just been working on a deal in that space. So it's much wide. The all Gulf investors will look a lot wider than just sort of pure high end resi or sort of single tenant, triple net corporate commercial real estate. Now, they are wanting to get superior returns. They look at geographies literally all over the world. They prefer developed markets, but if they can get deals they like in other places, they will absolutely look at them. So that's a great asset class. The two that are a bit slow at the moment are PE and venture, and I think that's really a function of the sort of hangover from pre-COVID. I mean, those asset classes went absolutely nuts, particularly venture, pre-COVID and during COVID, and then when we come out, the world sort of crawls out of its hole, has a look, realizes that rates are going up, and the model that has driven PE and venture particularly just evaporates. And a lot of people were left holding positions that were worth a fraction of what they were put on the books for. This is not a Middle East thing specifically. Some of the people in the Middle East were a little late to the party, particularly the venture party. We worked with a couple of venture managers during that period, and having been totally disinterested in the Gulf pre-COVID, suddenly decided they needed to get to the Gulf, which was a big indication to me that their fundraising sources in the US had pretty much dried up. So they were still raising out of the Gulf when the money in the US had seen the writing on the wall, and that's hurt people, which is sad. We never like to see investors get hurt. There were some ill-advised decisions, perhaps a little exuberant, a little over-optimistic on the valuations. Some of these will be fine. They can hold them for 10 years and they'll be fine. Private equity is similar sort of thing. Lack of deal flow, lack of recycling from, there's not a lot of distribution coming out of PE funds relatively to the past. So, you're not putting money back to investors. Those investors don't have that money to recycle back into other private equity funds. So the fundraising environment is a little constrained. There's not a lot of deals in the market due to the fact that the LBO market isn't really firing on all cylinders. We're hopeful that will come back during, we think rates coming down, it'll bring that market back towards the end of the year, maybe next year. Secondaries are interesting, but it's a very nuanced picture, and a lot of it's to do with the book of the investor rather than the proposition of the manager. It doesn't matter how good your private equity fund is if the person is over allocated or has some sort of impairment in their PE portfolio, they're not going to put more money into PE until they sort that out. However good you are, however much you want it, and that's just a reality of there has been and is continuing to be a significant portfolio rebalancing as a result of coming back to reality as far as rates go, and that means people have to rebalance, and that means they can't commit in the same way that they did before, and we're still in that process in the GCC.
What about things like in the US, for example, in the private equity space, you see things like continuation funds? Do you think that's going to become a trend in the Middle East?
Yeah, again, horses for courses among some investors, definitely. It's an asset class that serves particular types of investors extremely well. Has done. I'm not a private equity expert, and this is not a private equity podcast, but I think there is a question about whether those returns that have been delivered by private equity over the past 25 years, and it's not all to do with low rates because they did good returns, pre-low rates. Is there still room to deliver that type of consistent you know, high returns, high IRRs, high multiples over the next 20 years? Where is that value added going to come from? It's not going to come from leverage. Is there enough room in the market for corporate re-engineering, M&A, all that type of stuff? I don't know. People know a lot more than I do about this. But these questions are being asked as to, well, that was a great game. We need to be in it, but is it where we need to continue to be long term? Is it going to provide us with those really exceptional returns? And I think there are questions around that, which they weren't, people were not asking 5 years ago, but they're definitely asking them now. And then, all of the people in the Gulf really are saying, well, I can get X from doing a deal here in the GCC, Saudi, UAE, to a lesser extent the other places because they are quite small. Why would I then put all of my capital into the US? Or I think India is about to grow. I need to be deployed into India. Why would I put it into a UK private equity fund, which at best has middling prospects, when I can go into an India private equity fund, which should grow enormously just on the basis of the growth of the Indian economy? So there are changing patterns in the flows of capital, and those are reflected in the Gulf as they are elsewhere, with the exception that the local market has become much more attractive as a place to deploy capital than it was 4 years ago, and should continue to be an attractive place. It should be able to deploy institutional levels of capital more or less in an institutional way within the GCC, which was something you couldn't do 5 years ago. They have more choice, so they are more selective. You need to bring something better to the party.
What about like other asset classes, like things like, I remember Shore Capital doing a SPAC. I know SPACs in the US haven't been that popular anymore, but like a couple of years ago, Shore did a SPAC. And the other thing I was going to ask you, the two other asset classes were REITs, real estate investment trusts, and exchange traded funds. So maybe talk about those.
Well, look, these all form a part of the investment opportunity set that is faced by investors. There was a rather vague attempt to do SPACs in the GCC. I think there have been a couple. I don't know how successful they were. The SPACs have now got a bad name generally, in my opinion.
Well, Schwab been in a bit of trouble with a bond recently, so I don't think they're too.
Well, I don't know about that. I mean, I can't comment on the Schwab one. I don't know exactly what happened. But I mean, to be honest with you, they seem to me to be a way for the private equity sponsors to enrich themselves at the expense of everybody else. SPACs had a role pre the SPAC boom, and they were special purposes. They were a vehicle that you use to do an acquisition when no other vehicle worked. They weren't designed as blank check acquisition companies where there was an inbuilt, massive upside to the sponsors. Those that got in first did extremely well out of them. Those who were left holding the paper probably didn't. But hey, that's how finance works. So I don't think we're going to see a lot of SPACs in the GCC or people investing in them unless they come back in some global fashion where the narrative and the returns are extremely compelling. REITs, they've had a very checkered history in the Gulf. There were a lot of Saudi REITs. There's been REITs in the UAE. The performance has not been fantastic. I mean, some have been good, some have been bad. There was questions on the valuations of the original assets. There's all sorts of stuff that made them a little less exciting than they were thought to have been. But yeah, people will invest in them. I mean, again, I'm going to come back to my sort of stuck record, which is that you come to them with a compelling proposition as to why this is a good opportunity and why you are a good person to manage it, and show that you're committed to the client. You have a good chance. And it doesn't really matter what the structure is, as long as what you've got is suitable for the current requirements of the investors. And that's what we're all about at Soling, is giving our clients the understanding of what those current requirements are. Because so often you have a huge mismatch between what the manager wants to offer because it makes money for the manager, and what the client wants to invest in because it makes money for the client. And what we try to do in terms of narrative, in terms of structuring, in terms of negotiation, is to bring those two closer together to create something that works for both parties.
Very good. Richard, as we bring the podcast to a close shortly, I wanted to ask you about the importance of partnerships. Obviously, you've talked a little bit about, or you've talked a lot actually about structures and the kinds of capital raising and the kind of assets that are taking place. But how important are partnerships in all of this?
Well, I mean, we think they're absolutely pivotal. I mean, we're called Soling Partners, not Soling Capital, because we believe in partnership. You know, the nature of Gulf investors is they genuinely like partnerships. They're slow to get going. They are cautious about with whom they work because they've been burned by people that turn up and then disappear. They want to feel, as I've said a number of times, that the investment manager is genuinely committed to the relationship with the client, and you need to provide a Gulf investor with what we call and I was writing one of them for a client this morning, a strategic narrative or a strategic partnership narrative, where it's fine. It's like, we'll do this. This is step one, which is, a co-investment or a deployment into a fund or whatever. But the next step, as soon as that is complete, the next step is to create a co-investment sleeve, a co-investment program. Here are the terms. This is what we're going to invest in together. We, the international manager, will put our own money into this, our client capital, whatever it is. We dollar for dollar will go alongside you, and we've isolated and defined an opportunity set. We will work with you, the Middle East investor, and this isn't just sovereigns. This is aggregators. Everybody, does this. And we will do so on the following terms. And then, you can take it the next step of opening an office or having training staff or developing further initiatives on a deal by deal or other. Now, that works extremely well with people in the region. They like to put in a relatively small amount of capital to start with in a new relationship, and then to get to know and get to trust their counterparty, and then that counterparty becomes a favored partner, and will in time take more and more and more capital. And we've seen this with a number of fund managers where from very small beginnings they've built up multiple billion relationships across the region, 8, 10, 12 billion. These are not brand name asset managers. They're people that some people will have heard of, but many people won't. Every single one of those billions is in a segregated account, separately managed account. They're very specific mandates, and they play to the strength of the manager. The manager is extremely good at a particular thing. They provide scale. They provide competitive fees. They're very, very good at communicating with their partners in the Gulf. They do them the courtesy of showing them that, telling them what they're doing and showing them. It's very open. It's very transparent. It's very collegiate, and that works brilliantly. What fails is, hey, I got a hedge fund. Give me 50 million. I'm not going to tell you what I'm going to do with it. Maybe I'll come back. Maybe I won't come back. Don't know. That's going to get you nowhere. That's not what these people want. They're all in development mode. They're all developing markets in the purest sense of the word. They want to grow with you. They want to be part of your story. They maybe want to take a GP stake. They maybe want to share commercials. They maybe want to bring in some other investors. If you're not open to that as an asset manager and just saying, all I'm interested in is you giving me money, I'll manage it. And if it's okay, and I'll take a fee and a carry, and then I'll give you some back maybe one day, you're not going to get anywhere. there's we were down in Saudi last week, as I was saying, and we were talking to one of the institutions there privately without a client present, and just because we know them, and they were saying, you do know that a manager has to come and see us 3 times before we even open their pitch book. It's like we pretend that we're paying attention, but we're not. We want to see them. We want to see that they are willing to get on a plane, come and see us, tell us about themselves, introduce us to different people. And then, obviously assuming that the proposition has any value at all, then we will start what we call manager due diligence, where we will look at the manager, not the fund, not the strategy. We just want to know who this manager is. And we will go through a process of manager DD. Privately, publicly, we'll talk to the market, we'll talk to our advisors, we'll talk to different people who've had experience of working with this manager. And then, and only then, and this could be 18 months after the first conversation, will you pass the test and say, okay, you've shown that you're committed. We think you're a decent people. Now we're going to look at what you've got to do. Now, the problem that private markets has is that in the fundraising cycle, the fund that you may have started talking to them 18 months ago has closed. And you're not going to raise another fund for another 5 years, by which time you have to start the whole process again and you miss it. And we have seen this time and time and time again, that people come down with 6 months to run in a funding program, and they are never going to get capital out of the Gulf in a 6-month program if that's the first time. Our clients, we have 2 clients who've raised reasonable amounts in the course of this year. They started working with us in 2018. They came down. This is vintage 3. Now they're getting traction, but they had to go through many meetings, many disappointments, management of the expectations, and you can't approach the region without patience, without a real degree of partnership. You have to mean it. These people are not stupid. They're not rubes. They're not, there's this sort of slightly racist idea amongst certain people in the world that there's a bunch of idiots that somehow struck it rich and they were just throwing money about. It could not be less that. It could not be further from the truth. These guys are super smart. They see every deal in the world. They can invest anywhere with anybody. But yet people persist in turning up with unsuitable strategies and present it in such a way that it is take it or leave it. Well, it's leave it. And then they go away and say, I don't like the region. So we spend an enormous amount of our time with our clients working on their strategies, on how they put together, how they structure the feeders, how they approach the region, managing their expectations as to results, making sure that they understand the importance of relationships at different levels of the organization, that there's senior management buy-in, from them, that they've really thought through if they are going to open an office, where they want to put that office, that they understand the regulatory environment and are aligned with it. And the regulatory environment is complex, it's pretty opaque, and it's changing all the time. So the managers need to be seriously aware of that. Luckily, on the regulatory side, most of the regulators in the region are rightly concerned with protecting the retail market segment and the local market. But increasingly and rightly, they're looking at the role that international managers play and who they're talking to and what they're saying. And it will only go one direction. There will need to be, in time, if you're going to secure funds, you will need to have some form of local vehicle. It's already coming in Dubai and the UAE, slowly, but it's going to happen. And that presents a problem because there are, in fact, 9 different jurisdictions in the GCC. There are only 6 countries, but there are a number of offshore jurisdictions, and that, you've got to decide where you're going to be regulated. You can't be regulated in all 9. So it provides quite a lot of cost, and that's got to be worked through. So there are a lot of nuances and complexities, and our job is to help our partners and friends and clients navigate those towards a successful conclusion. But the final thing I would say is that we say no to people far more than we say yes, because we look at people and say, if I were you, mate, I wouldn't bother. I'd go, I'd spend another 3 weeks on the road in the US, or go to Japan, or get a distributor in Australia, because you're far more likely to find the sort of outcomes that you want than in the Gulf. So you got to be selective, you've got to be targeted, you've got to be thoughtful to succeed. And we like to think that we can help people do that.
Yeah. Richard, I have one other question for you, which kind of leads off to what you just said. Looking ahead in the rest of 24 and 25, what do you think the broader risks or challenges are to fundraising in the Gulf? Oil prices,
Well,
geopolitics.
first of all, I mean, I think the oil price is chimeric, because the oil price is, as it stands today, which I can't remember, 80, whatever it is really good for 5 countries of the region and really bad for Saudi, because Saudi's cut its production from 12 million barrels a day last year, 2 years ago, to 9 million. So Saudi's in a deficit. Now, Mohammed Al Jadaan, who's the finance minister, who's someone I know and respect enormously, is very much about that the budget is the budget, and we are going to continue to manage the budget through good times and bad. We're not going to have this boom bust that we've had in the past. And I think he's absolutely serious about that. I think MBS is serious about that. And they have the resources to be able to run a budget deficit. I mean, their debt to GDP is 27%. Their credit rating is strong. They've got plenty of road left to finance deficits. But even so, it has an impact. There isn't massive amounts of capital gushing into the economy. The non-oil economy is doing pretty well, but the oil economy is doing very poorly. And that to me, it would be much better for the Saudis, you would think, not that I know more than the Saudis about how to manage an oil market, to have a bit of a lower price for pumping more oil. But that's more of a political thing. So, a high oil price, as long as the production is there, is good for the region. It's helping Kuwait, it's helping Bahrain, it's helping Doha, all of that type of stuff, even though Doha is mainly based on gas. I'm not a believer in regional conflict in terms of involving the GCC. The GCC went through a sort of stage in the mid-2010s where it was being a little bit assertive, put it that way, with the rhetoric with Iran, the Qatar blockade or embargo or whatever you want to call it. And that they stopped that because they realized it was damaging them. And none of the leaders in the region and none of the sort of the policymakers want to have a conflict with anybody, even with each other. They just don't want this. It's like, we need to focus on our economic development. So they are going to go out of their way not to be pulled into a conflict on either side. You saw what, we thought they were going to, side with the West over Ukraine. They absolutely didn't. They said, look, that's your problem. You guys deal with it. We're going to trade with everybody. We'll trade with Russia. We'll trade with China. The US is putting a bit of pressure on that. We saw that the PIF's AI firm said that it would divest from China if the US asked it to, which is a kind of odd thing to say, but it's like, have they asked you to? Do you have any investment in China? Whatever. But they said they would, because G42 did that, which is the Abu Dhabi AI. And then they got whatever it was, 1.8 billion from Microsoft the next day. Hooray. Which, shows that Uncle Sam can be relied upon to look after his friends. But, they are non-aligned, but more in the Western camp than they are in sort of Russia, China. I think because they serve its interests rather than through any form of sort of loyalty or anything like that, and that's how it should be. I mean, these are sovereign states; they can do what they like. So I don't see there being a major geopolitical risk for the GCC. They are going to do everything they can to stay out of things. I don't think Iran wants to have a conflict with Saudi, which is where the fracture would come. I mean, there are people within Iran who would want that. So I don't see that being. I think high rates are not necessarily a problem for them. There's a bit of inflationary pressure in the economy. Keeping rates high for them isn't too bad. So I don't see. I think it's not. It's not super boom time in the Gulf, which is good. It's like solid forward progress in Saudi, in the Emirates, in Qatar. Oman has recently, I think, made some really good choices. The new Sultan has brought some energy. I mean, the old Sultan was an incredible man, just an amazing man, but he was tired and old. And I think the new Sultan has brought some much needed vigor back into Oman, and that's to be applauded. Kuwait, we're hopeful that the political deadlock will get better, and that therefore the investing institutions will be able to deploy more. We've heard from said institutions that this is their expectation, but we'll watch the space. And so I think the main issues are internal. It's things like the Saudi budget deficit, it's Vision 2030. I don't think that's going to be derailed in any significant way, despite what the line, the change in the line. I think everybody realized that it was going to take a lot longer to do this than they had originally thought. It's not being perceived in Saudi Arabia as a massive disaster, that's for sure. It's like, yeah, hey, well, look at all the other stuff. So I think longer term, it is the success of these diversification efforts, particularly in Saudi, that is the sort of key choice. One can worry about neighbors, but neighbors wouldn't be Iran. It would be places like Egypt. Egypt is a perennial worry for everybody. 110 million people crammed into, a physical footprint the size of the Netherlands. And then the environment. I mean, longer term, you've got to think about how climate change affects the region. You saw Dubai, was underwater. I was talking to a friend of mine in Dubai this morning who said it's still not back to normal.
Not just Dubai, Oman, Saudi. I think I saw some stuff in Saudi. It was quite bad flooding there as well.
Yeah, I mean, absolutely. But it was particularly visible in Dubai, and it's still affecting the city today in terms of its transport infrastructure, because it's just not set up to cope. And fair play to them. 10 inches of rain in 24 hours, nowhere in the world is set up to cope with that. If they did that in London, the place would be, half the basement flats in Chelsea would be underwater. More's the pity. But there we are. But I'm not slapping Dubai. I mean, they got really hit hard.
Wake up call, yeah. It's more a wake up call.
And if you got the temperatures and and all stuff. So they've got to get a handle on that. I'm more positive about that than I was 2 or 3 years ago. I think that they were really consciously ignoring it. And I think that Sultan and COP and all that stuff has actually woken them up to the idea that, hey, this matters to us too. Now, they're a good decade, or let's be charitable, 5, 6 years behind Europe, Asia, even the US in terms of realizing what they've got to do. But they'll get there. I think you try to say you'll bet against them is a big mistake. These guys are highly energetic, hugely ambitious. They've got capital resources. They've got a track record of achievement. And if you as a manager, to come back to our sort of theme here, if you are becoming part of that narrative, part of that solution, and that you are integrating their aspirational demands as well as solving their problems, then you will succeed. If you're just feathering your own nest, you won't. And that's a very simple thing to say, but it is the thing I say, 3 or 4 times a day to every day of the week to people is, look, you've got to think of this as a win-win, as a partnership, as adding value beyond simply delivering a 12% IRR over X number of years. Otherwise, they'll find somebody else who is going to give them that.
Yeah, definitely. It's not like instant coffee. Richard, tell us more about your current projects and your upcoming projects.
Well, I don't want to talk about my projects, rebuilding my house, which has taken me for bloody ever. But so if you, I'm moderating at the at Bonds, Loans and Sukuks conference in Dubai on the 5th of June. If any of you are going, do look me up. We're doing a half day on private credit, which I've been very fortunate to be involved in writing. That's the sort of next sort of big public appearance, as it were. We have a newsletter that we send out to clients. If people are interested in that, they can ping me an email. I know you're going to ask me for my contacts. I'm not massively active on social media. I mean, we tend to keep a relatively low profile with our, because we're a confidential advisor to our clients. We don't need to be shouting our name from the rooftop. We get most of our business through referrals, which is extremely nice. And we are, there are only really sort of three of us. We have a partner in Dubai, Rola, and Marius in California, who covers our American clients. And we don't really have much of a plan to increase that. It's not the skill set that we bring is unique, and it's extremely difficult to scale that. So we're more focusing on delivering for the people that we have than shouting from the rooftops that aren't we brilliant and you should hire us. Mind you, we are brilliant, and yes, you should hire us. But we gone are the days when I was on a conference stage every month telling the world about Saudi or Bahrain or Egypt or wherever. I miss it sometimes, but other times I really don't.
This has been great. This has been really great. Richard Banks, it's been a pleasure. Thanks for coming on the podcast.
Hassan, thank you. And I just want to thank you for having the initiative to do a podcast on the Middle East in such a way as you have, because I think there isn't one. And for people like me who remain after nearly 30 years fascinated with the market, I've listened to your back catalogue. I've listened to them now as they come out every few days. And I've never failed to find something that I didn't know and something interesting. So kudos to you for doing this. And I wish you every success. And I hope one day you'll have me back to talk about something else.
Thank you so much, Richard. And I'll also put Soling's details in the show notes.
Yeah, solingpartners.com.
Okay, that's great.
SOLING partners.com. It's a sailing boat. You can read about what it is on our website.
Very true.
And you can find me on LinkedIn, Richard M. Banks. And I'm reasonably good at responding to things, or just email me at rbanks@solingpartners.com.
Fantastic. Richard Banks, once again, thanks for coming on the podcast.
Been a pleasure, Hassan. Thanks a lot.